Okay, hey, Ryan here with James for the weekly mortgage update. James, let's get right into it. Rates, what are they doing this week?
Hey Ryan, so interest rates are definitely higher this week since the lows that we've seen of the year over the last week or two. We've seen a sharp move up over the last 10 days, especially since last Tuesday, and really attributed to Europe and the sounds of the bond buying or the quantitative easing, at least being talked about. The Central Bank of Europe eliminating the bond purchases or reducing them, at least cause global rates around the world to rise. So our 10-year Treasury bond went from 215 to almost 240 today, and that's a significant move in interest rates. The bonds themselves lost over 100 basis points in that time frame. So you're 3/8 higher on an interest rate today than you were 2 weeks ago Friday, 2 weeks ago today.
Oh, wow, okay. Today, then you were, all right, 2 or 3 weeks ago. What's that? And you're going to be way better at the math on this than I am. On a, say, on a $300,000 mortgage over the course of 30 years, what's 3/8 mean?
So 3/8 on you're talking somewhere in the neighborhood on 300,000, about a difference of $100 a month in the payment.
So times 360 months. I mean, that's
36 grand.
That for not pulling the trigger earlier.
Correct.
If things keep going up.
Yeah, no question. It is seasonal too, right? So the banks, the larger banks, where all the smart people are, they know this is the spring buying market, and a lot of most of the buying happens between May and August, and so they're going to issue 30-year paper. They're gonna run that up a bit, but also the economy itself, right? So our second quarter growth, and I always say that 10-year Treasury bond dictates consumer rates, dictates the 30-year mortgage rate in this country. It also mirrors or tracks GDP. So if you look at that, the economic activity for the second quarter is definitely better than the first. And we're looking at, some possibilities, again, that we talked about, that things actually improving and rates even going higher, but being able to sustain a higher interest rate because of better economic activity. People will have better cash flow, more money available, more confidence. You had a jobs number today, better than expected. Wages still flatlining, which we haven't seen inflationary pressure. And that's been really the story for the last 8 years. Continues the same, where you have unemployment rate ticked up a little bit today from 4.3 to 4.4, but wage pressure is not there. And you couple that with oil, again, being under $45 a barrel, which is the economic fuel of the world. And so with oil prices low, that affects everything, right? Transportation, which translates to higher food prices. I was reading over the holiday where, beef is the cheapest it's been in decades. So, in relation to eat as many, hamburgers you want on the 4th of July because beef is cheap. And so oil ties into that, and it really does affect other parts of the economy where we're not seeing the inflation pressure that even the Federal Reserve thought we would have at this point, with full employment as by the definition, and a little bit better economic activity, so that they are probably, the minutes also, the Fed minutes came out from the last meeting yesterday or the day before, it might have been, but they're looking at now, they're probably not going to raise rates again to the end of the year. They're going to watch and see where things are going, and they have that luxury because inflation is staying low. So their 2% target, we're still at 1.5%, and it's interesting. And I'm a big believer of what the old world economy, and a lot of these numbers don't really show, is the effect of technology. And so you look at, like Amazon, for example, and if you saw the news recently, they're buying Whole Foods.
Yeah.
Amazon has changed the game as Walmart, right? And the prices that we pay on consumer goods. That is a fundamental driver and factor in the economy. That type of pricing is not in any of the models that you'll see economically, at least from the federal level. Of course, the governors are cognizant of it. There's the smartest bankers in the country. But it's really the reality, because they're scratching their head saying, why is there not wage pressure? And productivity has kind of flatlined as well. Where's the wage pressure? Where's the inflationary pressure? How do we have full employment? But in reality, that's created a situation that's very, very good for the consumer and the housing market. If there was ever a doubt, housing is 100% back, in my opinion, and I can make that statement loud and clear. And I think anybody in the industry would agree to that. And the reality is, from 1960 to 2004, real estate nationally returned 6 to 8%. And obviously, you had the financial crisis. And I always say, those are the events that go into the history books because they're unique and they are history-making events that I don't think we will see maybe again in our lifetime, right? I mean, you had the Great Depression, you had great inflation in the 70s with the oil crisis and things like that. I mean, these are phrases that have transcended generations because they're historical events. And now, ultimately, this will go down as the Great Recession or financial crisis. And so when does something like that happen again? And I think, for the last 10 years, we've had that scare, or at least that feeling of being scared and still remembering that, and we should never forget it. And I think we've made a lot of fundamental changes. But the reality is, I think going forward, we're in a great spot.
So you seem pretty optimistic about things. Like, we've learned our lessons. The environment's going to stay good for a long time. And of course, there's a lot of people out there going bubble again because they think history is just going to repeat itself again 10 years later.
Yeah, I think I don't see that. I see that we're more, okay, you're going to have your areas where prices are going up, but how is that money being made available to the people that are bidding up those prices, right? So typically they're coming in with more liquidity. That prices are not going up because everyone's getting 100% financing.
Right.
If they're going in a competitive situation and a property has 6, 7 offers today, it's usually the person that's putting 30% down that wins the deal. So the fact that the leverage is not there, and you have first-time home buyer programs, but where there is leverage in the lending business today, those guidelines are much more stringent. You have to have a little skin in the game. You got to show me you can afford the payment. You got to have decent credit. So that's where the formula really got skewed. It was, don't show me anything. I don't care if you're credit worthy. And here's $2 million at 100% financing.
Yeah. So that's a good transition into what we did yesterday. I just want to point out the bank statement only stuff we've been talking about. If you go over to bondstreetmortgage.com, it was July 6th. You'll find that post if you're watching this later. But we did a little talk about bank statement only qualifying for mortgages. And that might be an example of something that might seem a little looser, but actually it's pretty responsible, right? The way it's being done. Cash flow to me is as important as income. And again, for the entrepreneur, you're running a business, even as an independent contractor, you're paying your own marketing, you're paying your own expenses. You know what you're left with at the end of the day. And because the conventional way is to use your net income to qualify for a mortgage, when you probably know and can demonstrate with good credit, you're not overextended on your credit cards. There's signs of a person who I believe as a lender we can distinguish has the ability to repay the loan, not just on the aspect of, okay, this is the box, right? There are people that are outside the box that absolutely, I always say, if you deserve a mortgage, we're going to find a way to get you a mortgage. And the key there is deserve. And, unfortunately, in all of this, the self-employed individual, the entrepreneur, has been the most limited by the new lending practices. And I think that's starting to change. Yep. So if you're a realtor specifically, or another lender, realtor watching this, and you want financing for your own stuff, this is something to pay attention to. And also let all the business owners know that this is an option. You might be able to generate some additional business you wouldn't have before just by educating people. Feel free to share our content, right, James? That's why we do this. People can share this on Facebook, YouTube. Go ahead and bet it in your blog. We don't care. So
it's good content. Obviously, we love to promote ourselves, but the content is very good and it's helpful information for all. You know, if you look at the Bond Street Mortgage, there's a lot of great content there to share all over social media for a lot of different topics. And we're more than willing and honored to, you know, share our services and information with your prospective clients as well.
Okay, and then moving on, basically I'm going to get extremely geeky right here, and there's probably, I don't know, besides you and me, like 2 or 3 agents out there who are going to even understand what I'm about to say, but they'll love us for this. We do a lot of automated text responses when we generate leads, James. And I learned recently, one of the big hiccups is that you can't really bi-directionally text. You have to kind of go into your CRM, find the person's name, and then send a manual text back from your phone. There's a Zapier Zap for anybody who understands what the heck I'm talking about. There's an idea you could try is actually email the text over the notification to yourself so that you can then click the phone number and send a text from your phone. I don't know if anybody's going to appreciate that, but I wanted to share it. I'll usually do a tech tip at the end, and that's it. Anybody who's like, what the heck did you just say? Feel free to reach out to me, Ryan@BondStreetLoans.com. James, I'll explain a little more in a few minutes when we get off this. And that's it. Twilio, by the way, is a SMS messenger service. And if you're not already, you know, whether you're a realtor or not, if you have your own business, if you're not already sending a text right away to your new leads, you're really missing out on revenue. So this applies to anybody, not just realtors and mortgage people. If you own a business, pay attention to this. And again, Ryan at Bond Street Loans, I'd be happy to answer anything.
Yeah, absolutely. As much as real estate back, I think email is dead.
Emails are dead? Yeah. And I just said email the text to you, which makes it even crazier.
Well,
Okay.
from our perspective as the business person, it's a great connect. But again, you know, when we're talking about marketing out, and obviously email still is very relevant, but everyone's kind of, you know, flooded the consumer with email. And because of spam filters and things that I learned from you, a lot of the stuff isn't getting through anyway. So it's just another level of contact and engagement. And the text is something more immediate. And the average person spends, you know, something like, I think I read 6 hours on their mobile device. And I'm sure that'll be going up as the younger generations come online as well. So. Yeah,
the open rate on a text is about probably 95%. You know, people see it, and then we're finding across the board, everything I see, 20 to 30% of people will at least reply and tell you to they might say something rude, but you'll get some kind of engagement.
And what would you say email open rate is?
Much lower, especially on a real estate lead. For example, if somebody registers on your real estate website and registers to search for properties, unless that first email you send is really engaging, is short, and is really well crafted, you're probably looking at well under 10% response. 1 in 10 people might say something back to you. Text, you're going to be looking at 20 to 40%, maybe better if you really know what you're doing and everything's targeted. So,
I agree with that number. I see it from the analytics. It's definitely under 10%. So it's a little better than sending a postcard, for sure, better percentage. But like I said, I do see that we're kind of reaching a saturation tipping point with email.
Yep. Okay. Well, thanks everybody for watching today. James, you good to go?
Great, Ryan. Thank you. Have a good weekend.
We'll see everybody next week. You too. Have a good one.
Talk to you soon.